Welcome to our deep dive into global crises and specifically how those crises can really shake things up in the financial markets. We've got a really fascinating mix of sources here, articles, research papers, all sorts of stuff dealing with, economic downturns and political, let's just call it fireworks, right? Financial meltdowns, even some stuff about environmental shocks and tech disruptions.
Well, and I think the really fascinating thing is how it's not just about these individual crises,
Yeah.
It's about understanding how they're all interconnected, how what happens in one part of the world can end up influencing your portfolio.
Yeah, absolutely. So that's what we're going to do today. We're going to try to, connect the dots and really unpack how different events end up rippling through the system and how that affects, financial markets around the globe. And most importantly, how all this knowledge can help you to make some smarter decisions. And maybe, just maybe, we'll even be able to spot some opportunities amidst all the chaos. Let's start with something that I think we can all remember pretty vividly, the 2008 financial crisis. It really showed us just how much a global economic downturn can impact every corner of the market.
It really did. When a major economy, let's say the U.S., just as an example, starts to struggle, everybody feels it. So you see less spending, businesses start shrinking, you see stock prices really start to take a hit, especially in those industries that are, super sensitive to those economic shifts. Think, luxury goods, travel, things like that.
Yeah, almost like a domino effect, right? Where, one thing leads to another and the whole system is suddenly kind of shaking.
Exactly. You also have this thing called the flight to safety. So as investors start to get a little skittish, they want to move their money somewhere safe. So they pull out of those riskier assets like stocks, and they kind of flock to these assets that are seen as a little more stable, like government bonds or gold.
Okay. So how does that actually work? Like, what is it about those government bonds that makes them such a safe haven during times like these?
Think of a government bond, kind of like an IOU. It's from a very reliable borrower, the government. And they promise to pay you back, plus a little interest on top of that. Now, during times of uncertainty, investors are willing to accept lower interest rates, which we also call yields, just for that security of knowing that their money is going to be relatively safe.
Right.
So as the demand for those bonds goes up, their yields tend to go down.
That makes a lot of sense. So that's why we often hear about these bond yields falling during a crisis, right? It's a signal that people are kind of, looking for a safe place to park their money. What about gold, though? I mean, why is that considered a safe haven?
Gold has this long history of being a store of value. I mean, it's finite, it's tangible. It's not tied to any one particular economy or currency. So when the financial system feels a little rocky, people see it as a way to kind of preserve their wealth. So as that demand for gold increases, you guessed it, the price goes up.
Makes sense. So we've got these ripple effects happening, through these different industries. We've got this rush for safety, whether it's bonds or gold. But what about currencies? I mean, you mentioned that earlier. How do currencies get pulled into this whole mess?
You can think of a country's currency as a reflection of their economic health. When that economy weakens, the currency loses value compared to others. So again, going back to that U.S. example, if the U.S. economy slows down, the U.S. dollar might weaken against, let's say, the euro, meaning it's going to cost you more dollars to buy the same amount of euros.
Yeah, that would definitely make that trip to Europe a little bit more expensive, right?
Yeah.
But I bet those currency fluctuations, they also mess with trade a lot, right? Because the costs of, importing and exporting all of a sudden are changing based on those exchange rates.
Absolutely. Absolutely. Currency fluctuations, especially rapid ones, can create some real headaches for businesses that have to rely on international trade.
Yeah, they could see those profits shrinking pretty quickly. Okay, so we've seen how that economic instability can really have this, domino effect on the markets. But let's shift gears for a second. What happens when things get politically shaky? I remember back in 2018 when there was all this talk about trade wars and tariffs and the markets just went haywire. It felt like, every day was a new wave of uncertainty.
Right. It's those geopolitical events, things like conflicts, sudden government changes, trade wars, any of those things. They really inject massive uncertainty into the system. And investors, well, they hate uncertainty.
Yeah, it makes it hard to predict what's going to happen next.
Exactly. So they react by pulling back from those riskier assets, especially those that are linked to the countries involved in, all the drama.
So that's why we often see these stock markets dipping when there's, political instability in any part of the world. It's like they're hitting the pause button while they're waiting to see how things are going to play out.
Exactly right. Yeah. I mean, one really good example of this is what happened in Russia after the annexation of Crimea, right? The sanctions that were imposed by the West caused the ruble to just crash. And the stock market in Russia, it tumbled.
Yeah. And even thinking back to that U.S.-China trade war, all of those tariffs that were going back and forth, that created so much tension.
Absolutely. Absolutely. And, it disrupted global trade flows, making it hard for businesses to plan for the future. And of course, that uncertainty, well, it often translates into more volatility and price swings in the market.
It's almost like everyone's just, waiting for the other shoe to drop, holding their breath.
And sometimes all of that uncertainty leads to something we call capital flight.
I've heard that term before, but honestly, I'm not really sure what it means. Can you break it down for us?
Sure. So imagine you've got a bunch of investors and they have money in a certain country. And let's just say they're starting to, lose confidence in that country's political stability or its economic prospects. What do? They start pulling their money out. They move it to places that they think are safer. That's basically capital flight. It's like a mass exodus of money from anywhere that is seen as too risky.
And that can't be good for the country that's experiencing it, right?
You're exactly right. It can be devastating for their economy. When all of those investors pull their money out, it drains their foreign currency reserves, and it makes it harder for them to pay for things like imports or even service their debts. This could even lead to a currency crisis where the value of their money just plummets, and that makes imported goods more expensive and, well, it can fuel inflation.
So it's not just about investors protecting their own money. It's about all of these potential knock-on effects that it can have on the whole economy.
Exactly. We've seen recent examples of this in places like Venezuela or Argentina, where you have political instability and economic mismanagement.
Yeah.
It triggered this massive capital flight, which led to severe economic downturns. I mean, it can really create hardship for the people living there. It's a stark reminder that, political risk can have real-world economic consequences.
Okay, so we've covered economic and political crises, but let's talk about the kind that really send shivers down everyone's spines, the full-blown financial crises.
But when it rains, it pours kind of moments.
Exactly. What makes these events so scary? And, what are some of the warning signs that one might be brewing?
These are like financial earthquakes, sudden, devastating. You'll see a combination of things happen. Major financial institutions failing, credit markets freezing up, and just this sudden lack of liquidity in the system.
Okay, time out for a second. I know we've been using this word liquidity, but can you explain what that actually means in plain English? It's one of those financial terms that always makes my eyes glaze over.
Yeah, think of it as the lifeblood of the financial system. It's the ease with which you can buy or sell assets without causing these, drastic price changes. When there's a lot of liquidity, money is flowing freely. Businesses can get loans, investors can buy and sell stocks without any major interruptions, and the whole system runs smoothly.
So a lack of liquidity means that money flow gets choked off.
Exactly. And when that happens, things start to grind to a halt. Businesses can't get the loans they need to operate, investors get spooked and pull back from the market, and the entire economy can seize up.
And that's kind of what happened in 2008, right?
The 2008 financial crisis, that's a classic example of a liquidity crisis. It all started with the collapse of Lehman Brothers. You remember that?
How could we forget?
Right. Well, when they collapsed, it triggered this chain reaction. Other banks were afraid to lend money to each other because they didn't know who else might be holding these, toxic assets. So the credit markets just froze, businesses couldn't get financing, and the economy went into a tailspin.
It's kind of scary how quickly things can unravel like that. Okay, so we've talked about these financial meltdowns. But what about other types of crises? Like how do environmental disasters or, even pandemics or even climate change, how do those things mess with the markets?
Well, they're becoming increasingly important factors, and they present both risks and opportunities. In the short term, natural disasters, whether it's hurricanes or earthquakes, they can really disrupt economies, damage infrastructure, and create chaos in supply chains. Think about Hurricane Katrina back in 2005.
Right.
Devastated the Gulf Coast, caused major disruptions in oil production, and just sent energy prices soaring.
Yeah. And we saw something very similar happen with COVID-19. It was a real wake-up call to how fragile global supply chains really are. We had lockdowns and travel restrictions, which caused those shortages and price hikes and everything, from toilet paper to computer chips.
Right. And then you have the long-term impact of climate change, which is, a game changer for sure. We're seeing these shifts in energy markets as the world tries to move away from fossil fuels and embrace renewables. And this transition is going to create challenges and opportunities for investors.
So you're saying, like, the oil and gas companies might be facing headwinds, while companies involved in, say, solar or wind energy, those might see their fortunes rise.
Exactly. It's all about understanding how those long-term trends are reshaping the investment landscape. And the pandemic, as tragic as it was, well, it actually accelerated some of these trends.
How so?
Well, it forced a lot of businesses to adopt remote work policies and embrace, digital technologies. And that gave a huge boost to companies like Zoom or Microsoft, while traditional brick-and-mortar businesses really struggled to adapt.
It's fascinating how a crisis can really accelerate trends that are already in motion and force us to adopt those new technologies and ways of doing things. Okay, last category to tackle. Technological crises. We live in a digital world. What happens when that technology goes wrong? Or when there's some kind of major cyber attack? What if it hits a financial institution or even critical infrastructure?
That is a chilling thought. I mean, the potential for disruption and panic is huge. Just imagine, a major bank's systems get hacked, customer data is compromised, or what if a country's power grid is taken down because of a cyber attack? The impact on the markets would be immediate and severe. I mean, trust would erode fast, and liquidity could dry up practically overnight.
It's like a digital domino effect, right? Where one failure triggers this cascade of others.
Exactly. And it's not just about cyber attacks. We also have to consider the disruptive power of technologies like, artificial intelligence or automation. They're reshaping entire industries. They're going to be winners and losers.
Yeah. A perfect example is the rise of electric vehicles and the decline of traditional car companies. It's happening so quickly, it's even more important to understand those forces at play.
Absolutely. Investors who can anticipate those shifts and identify the companies that are poised to benefit, they'll be in a much better position. But those who fail to adapt, well, they risk being left behind.
Okay, so we've covered a lot here. Economic downturns, political turmoil, financial meltdowns, environmental disasters, even tech disruptions. And we've seen how each of these can send shockwaves through this financial system. But I think there's one more piece of the puzzle we need to discuss: supply chain disruptions.
You are absolutely right. That is a critical element, especially in our world today, with everything so interconnected.
Yeah. We've seen how all of these different types of crises can mess with those supply chains, but what does that actually mean for us? How does it affect our daily lives? How does it affect our investments?
Think about it this way. When it becomes harder to produce or transport goods, prices go up. That's inflation. And while a little inflation is normal, a sudden surge in inflation can be very damaging to the economy and to the markets.
Yeah, it eats into our purchasing power, making it harder to afford, well, just the things we need, and then it can squeeze corporate profits, right? Which leads to lower stock prices and, well, market downturns.
You got it. And COVID-19, that was a painful reminder of just how fragile those supply chains are. Remember the empty shelves at the grocery store, the shortages, the price hikes on everything.
Lumber, used cars, you name it. Yeah, it was a wake-up call. It showed us how interconnected the world is and how easily those connections can be disrupted.
Exactly. And that's why understanding these dynamics, the interplay between those crises, the supply chains, inflation, it's crucial for navigating the financial world.
It's not just about understanding individual events, but how they fit together.
Precisely. And that's exactly what we'll explore further in part 2 of our deep dive. We'll actually examine some specific examples of how these crises have played out in the real world.
Sounds good. I'm looking forward to diving a little deeper into those historical lessons. Welcome back. Last time, we covered a lot of ground, looking at how different kinds of global crises can ripple through the financial system, impacting everything from specific industries to, currencies, even things like gold.
Right, those safe havens.
But I'm really curious to see how some of these concepts have actually played out in, real-world situations.
Yeah, I think sometimes looking back at history can give us a much better understanding of the present, even the future. It's like having a crystal ball. But instead of looking forward, we're kind of looking back to learn from the mistakes, maybe even the successes of those who came before us.
So, where should we begin this journey through financial history? What would you say had one of the most profound and long-lasting impacts on the global financial landscape?
Well, we can't talk about financial crises without revisiting, the granddaddy of them all, the Great Depression. I mean, it's like the Mount Everest of economic downturns.
I've read so much about it, but it's still so hard to really grasp the sheer scale of it all.
It began with the stock market crash of 1929. but it quickly spiraled into a decade of economic devastation. Widespread bank failures, unemployment rates going through the roof, and global trade just came to a standstill. In the U.S. alone, unemployment reached a peak of 25%, which is just,
Wow, 25%. It's hard to even fathom that today. And you mentioned global trade being impacted, so this wasn't just like a U.S. problem.
not at all. The Great Depression's effects were felt worldwide. Countries that depended heavily on trade with the U.S., their economies contracted because that demand for their exports just dried up. It really showcases how interconnected the world had become, even back then. One country's problems can quickly spread across borders.
It's like a stark reminder that the global financial system, it's a lot more fragile than we sometimes realize. But what were some of the key factors that contributed to the Great Depression in the first place?
Well, there were a number of factors that played a role. But some of the key contributors were excessive speculation in the stock market, loose credit policies that kind of fueled a debt bubble, and then a lack of, effective government intervention early on.
So it's like a perfect storm, almost. Risky behavior, easy money, not enough oversight.
Yeah. And the consequences, as we know, were quite profound and far-reaching. It actually led to a lot of social and political upheaval, not just in the U.S., but around the world.
And it forced governments to rethink their approach to things like financial regulation.
Yeah. Right. The Great Depression was a wake-up call. It highlighted the need for safeguards to, at the very least, mitigate future crises. And that led to some really significant reforms, including the creation of the Securities and Exchange Commission, the SEC here in the U.S., to regulate the stock market. We also got the Federal Deposit Insurance Corporation, the FDIC, which insures bank deposits and, helps to prevent bank runs. All of those things really helped to stabilize the financial system and restore confidence in the markets.
So out of the ashes of this crisis came some really important institutions and regulations that are still with us today. It's a reminder that, even from the darkest of times, some positive changes can emerge.
Absolutely. It's a testament to our ability to learn from our mistakes and, just build a more resilient system. But of course, history often repeats itself, just in different forms.
Let's jump ahead to the 1970s. That was a decade marked by another, major crisis. The 1970s oil crisis.
Yeah, I've seen pictures of those long gas lines. It must have been a really crazy time. It was a period of significant economic and political turmoil. And, the crisis was actually triggered by an oil embargo imposed by OPEC, which is the Organization of the Petroleum Exporting Country.
OPEC, right.
Yeah, this was back in 1973. And they were protesting Western support for Israel during the Yom Kippur War. They decided to use oil as a weapon.
So this was a geopolitical event with massive economic consequences.
Exactly. It caused oil prices to just skyrocket, sending shock waves through the global economy. Oil, as you know, is the lifeblood of modern industrialized societies. And suddenly everything became much more expensive, from gasoline to heating oil to, the transportation of goods.
And that led to that nasty combination of high inflation and slow economic growth, right? What do they call it? Stagflation.
You got it. Stagflation. And it was a new phenomenon at the time. Economists were baffled by it. They were used to seeing either high inflation or slow growth, but not both happening at the same time.
Yeah, it was definitely a tough time for everyone. So what was the impact of this oil crisis on the financial markets?
Stock prices definitely tumbled. Businesses were grappling with those rising energy costs and just declining consumer demand. And, of course, investors, as they tend to do during times of uncertainty, they start looking for safer havens. And once again, gold became a popular choice, and its price surged.
So interesting how these patterns tend to repeat themselves. Investors get nervous, flee to safety, and gold shines.
Exactly. And the oil crisis also had a lasting impact on energy policy. It highlighted the need for energy independence and diversification. And a lot of countries started investing in alternative energy sources and, exploring ways to reduce their reliance on that foreign oil.
So again, a crisis can actually be a catalyst for innovation and change.
It really forces us to confront those vulnerabilities, come up with new solutions.
Absolutely.
Now let's fast forward a few decades to the late 1990s, early 2000s. This was a period of, rapid technological advancement, exuberance. But it ended with a painful reminder that, what goes up must come down. The dot-com bubble.
The dot-com bubble. Man, I remember hearing all these stories about people quitting their jobs to become day traders, pouring all their money into tech stocks. It seemed like everyone was just trying to get rich quick.
It really was a time of irrational exuberance. The internet was still, relatively speaking, new. There was a lot of hype around its potential to transform the world, which of course it did. But investors were pouring money into these internet-based companies, driving up their valuations to, well, unsustainable levels. I mean, a lot of these companies, they had no profits, no proven business models, just a catchy name and a .com at the end of it.
So what happened? I mean, what caused the bubble to burst?
Eventually, reality sets in. Investors started to realize that many of these companies, well, they were overvalued. And the internet, while it was transformative, it wasn't some magic money machine. So as those doubts started to creep in, the market began to correct itself. The NASDAQ, which is heavily weighted toward tech stocks, peaked in March of 2000. And then, well, it went into free fall.
So it was like a collective oh no moment.
Pretty much. The air came out of the bubble, stock prices crashed, and a lot of .com companies went bankrupt. Investors lost billions of dollars. It was a painful lesson, about the dangers of speculative investing and the importance of those sound business fundamentals.
It's a good reminder that even when we have these technological revolutions, the basic principles of investing, those still apply.
Exactly. You can't ignore the fundamentals, revenue, profits, and a solid business model. But the dot-com bubble did have some positive consequences. I mean, it forced investors to be a little more discerning and to, focus on companies with real potential rather than just the hype. And it also spurred innovation. The companies that survived that crash, they had to become leaner, more efficient, more focused on delivering, real value.
So another example of how crises can lead to, both destruction and creation. It can wipe out the weak and pave the way for the strong.
Precisely. And that brings us to, well, another major crisis, one that hit much closer to home for a lot of us, the 2008 financial crisis.
Yeah, that one is still pretty fresh in a lot of people's minds, and that was a global crisis, wasn't it?
Absolutely. It started here in the U.S., specifically the housing market, but it quickly spread across the globe, and it really highlighted how interconnected that global financial system is.
And it all started with those subprime mortgages, right?
You got it. Subprime mortgages are those loans that are given to borrowers who, well, they don't have great credit histories. They have a higher risk of defaulting. And, in the early 2000s, housing prices here in the U.S., they were soaring. Lenders were very eager to make money. So they started loosening their lending standards, and they were offering these risky mortgages to people who really couldn't afford them.
It sounds like, I don't know, a recipe for trouble.
Yeah. And these mortgages were then bundled together into these really complex financial instruments, these things called mortgage-backed securities. And they were sold to investors around the world. The problem was that many of these securities, well, they were built on, kind of shaky foundations, those risky subprime mortgages. And when housing prices started to decline and borrowers started defaulting on those loans, the value of these securities just plummeted, causing massive losses for investors.
Oh, and then the panic set in.
Exactly. The financial institutions that had invested heavily in those mortgage-backed securities, they started to crumble. Lehman Brothers, a major investment bank, they filed for bankruptcy in September of 2008. And that really just sent shockwaves through the entire global financial system.
Yeah, I remember those headlines. It really felt like the world was on the brink.
It was an uncertain, frightening time. Credit markets froze because banks were afraid to lend money to each other. Businesses couldn't get the financing they needed, and, well, the global economy plunged into a deep recession. Governments around the world, they had to step in with massive bailouts and stimulus packages to try and stabilize the system and prevent a complete meltdown.
So once again, we see this. How a localized crisis, this time in the U.S. housing market, how quickly that can escalate into a global crisis.
It really did. The 2008 financial crisis showed us how important things like sound risk management practices, responsible lending standards, and effective regulation are. We have to have those things in place to prevent excessive risk-taking.
Okay, so we've covered the Great Depression, the oil crisis of the 1970s, the dot-com bubble, the 2008 financial crisis. Any other historical examples you think are worth exploring before we move on to discussing, strategies for navigating these turbulent times?
It really is fascinating how those crises, even though they have these unique circumstances, often share these common threads. Excessive risk-taking, not enough regulation, and just how interconnected those global markets are.
It's like history keeps trying to teach us a lesson. Are we even listening, though? Hopefully, by looking back at all of these events, we can be a bit more prepared for the next challenge, right?
Exactly. Understanding these historical patterns is so key to navigating, whatever comes next. It's about recognizing those signs, figuring out those risks, and adapting our strategies.
So let's actually talk about what we can do. As investors or even just everyday people trying to make sense of the world, how do we actually navigate these, turbulent waters? What are some practical strategies we can use to manage that risk and maybe even find those opportunities in all the chaos?
It's funny. A lot of people think of crises as, purely negative things. And while, yeah, of course, they bring all these challenges and disruptions, they can also create opportunity.
That's an interesting way to look at it. So how do we actually shift our mindset from that fear to opportunity? Where do we even begin?
I think the most important thing is to stay informed. I mean, you wouldn't drive a car with your eyes closed, would you? Well, the same goes for navigating the financial markets. You got to keep your finger on the pulse of what's happening globally. Understand those potential implications and adjust that investment strategy accordingly.
So no burying our heads in the sand.
No way. A well-informed investor is a much more resilient investor. You need to be paying attention to those economic indicators, geopolitical developments, and any of those emerging risks that could impact those markets.
Okay, so stay informed. Got it. But there's just so much information out there. It's so easy to get completely overwhelmed. So how do we cut through all the noise and focus on what really matters?
That's a good point. It can be overwhelming. That's why you have to be really selective about your information sources. Choose reputable financial news outlets, subscribe to industry newsletters, follow experts who really provide that insightful analysis, and remember, diversify that information diet.
What do you mean by that?
Don't just, stick to one perspective. Get a variety of viewpoints. That'll help you get a more balanced understanding of what's happening. One source might be overly optimistic, another overly pessimistic. By considering multiple perspectives, you can form your own well-informed opinion.
That makes sense. It's kind of like getting a second opinion from a doctor, right? You want to gather all of that information before you actually make a decision.
Exactly. And it's not just about passively absorbing information. Engage with it critically. Question those assumptions. Consider different interpretations. And don't fall for all the sensationalism or hype that's out there. There's a lot of noise, especially on social media. So it's really essential to develop those critical thinking skills. You have to filter out the noise.
Okay, so we're staying informed, we're diversifying that information diet, and we're engaging with it critically. What's next?
Well, once you have a good grasp on, what's actually happening in the world, then you can start thinking about, okay, how can I position my portfolio to, weather that storm and maybe even benefit from it? And that's where diversification comes in.
Diversification. Yeah, the classic, don't put all your eggs in one basket. I've heard that so many times. But honestly, sometimes it feels, I don't know, a little cliche. Can you just explain why it's so important, especially during these times of crisis?
Imagine you have all of your money invested in a single stock, and then all of a sudden, that company gets hit hard by some global crisis. Maybe it's an airline that's struggling during a pandemic, or I don't know, maybe a tech company facing supply chain disruptions. Suddenly, a big chunk of your savings is at risk.
Ouch. Yeah, that would hurt.
But if you spread your investments across different asset classes, stocks, bonds, real estate, maybe some gold, maybe even commodities, well, you're creating a safety net. So if one area of your portfolio takes a hit, the others can help to cushion the blow.
It's like having a team of athletes, right? If one player is injured, the rest of the team can step up.
Exactly. And diversification, it's not just about having different types of assets. It's also about spreading your investments across different sectors, maybe different geographic regions. So that way, if one particular industry or country is facing a challenge, your whole portfolio isn't getting dragged down.
So for example, if I'm worried about a slowdown here in the US, I might consider investing in, emerging markets, those markets that are expected to grow more quickly.
That's one way to approach it, yeah. And even within the U.S. market, you could diversify by investing in sectors that aren't quite as sensitive to those economic downturns, like healthcare or consumer staples.
So it's all about spreading that risk. You're not overly exposed to one event or sector.
Exactly. And speaking of risk, it's really important to take an honest look in the mirror. Assess your own risk tolerance.
Risk tolerance. Is that just a fancy way of saying, how much risk I'm comfortable taking with my money?
Pretty much. It's a very personal thing.
Yeah.
Some people are okay with, riding the roller coaster of the stock market, while others, well, they prefer something a little smoother, more predictable.
So if I'm saving for retirement, decades down the road, maybe I'd be more comfortable with a higher risk, higher reward strategy than someone who, needs access to their money much sooner.
Exactly. And someone who's closer to retirement, They might prefer to be more conservative, focusing on preserving capital, maybe generating income. It's about aligning that investment strategy with your goals, your comfort level with risk.
And I would imagine that risk tolerance, that can change over time, right? Maybe I'm feeling a bit more adventurous when the market's doing well, but when things get shaky, I want to pull back a little bit.
Absolutely. Absolutely. Risk tolerance, it's not a static thing. It can change. It can be influenced by things like your age, your financial situation, even your emotional state. It's important to check in with yourself every so often and make sure that your investment strategy still aligns with your, current tolerance for risk.
So we've covered staying informed, diversifying our portfolio, and assessing our risk tolerance. But you mentioned earlier that, crises can create opportunity. So can you tell us a little more about that? How do we spot those diamonds in the rough?
A lot of times, crises create what we call market dislocations. That means asset prices don't line up with their true value. And that's where opportunities can pop up. For those investors who are willing to do their research, think outside the box.
So it's about finding those undervalued assets, those companies or sectors that have been, unfairly punished by that market panic.
You got it. It takes careful analysis and a contrarian mindset, that willingness to maybe go against the crowd and, bet on something that others are overlooking.
But that sounds kind of risky too, right?
It can be.
Yeah.
And that's why it's so important to do your research. Understand those fundamentals. You have to manage that risk appropriately.
So even when we're trying to, capitalize on opportunity, it all comes back to managing risk.
Exactly. Remember, markets, they tend to recover eventually. So patience and discipline, those are your allies when you're navigating, these turbulent waters.
Okay, so we've talked about staying informed, diversifying our portfolio, assessing our risk tolerance, and even spotting those potential opportunities. Any other, pearls of wisdom before we wrap things up?
One of the most important things, you're not alone in this. These crises impact everyone, and they often bring out, the best in us as we come together to support one another.
It's easy to focus on our own individual worries, but at the end of the day, we're all in this together. And working together, well, that's essential for getting through these global challenges.
Absolutely. And lastly, I would encourage everyone to cultivate that growth mindset. Embrace those learning opportunities that these crises present. They force us to think about our assumptions, adapt to that change, and become more resilient.
So even when there's uncertainty and disruption, there's still a chance to learn and grow from it.
Absolutely. By staying informed, adapting, and focusing on the long game, well, we can weather those storms.
Yeah.
And even come out stronger and wiser.
That's a really inspiring note to end on. Thank you so much for guiding us through this deep dive, global crises and the financial markets. It's been a fascinating and insightful journey.
It's been my pleasure. And remember, knowledge is power. Understanding how these global crises work and how they impact those financial markets, well, that can help you to make better decisions. You can manage that risk and you can navigate whatever comes next with more confidence.
And to all of our listeners out there, thank you for joining us for this deep dive. We hope you found it valuable. Remember, the world is constantly changing. And staying informed, well, that's the best way to navigate those challenges. And of course, seize all those opportunities that are waiting for you. Until next time, keep learning, keep growing, and keep exploring.